Hello, welcome back, and let's talk about position sizing and risk management a little bit. And in the first part of this video, it will be a little bit theoretical. I will explain a few important terms and concepts, and then in the second half, we will take a look at how to actually size our positions to get a certain risk in our trading platform. So let's get started. And what is a pip? A pip is, or it stands for point in percentage. That's usually how traders in Forex measure distances on their charts to determine how far the price is going or how far a take profit will go, and also how far your stop loss will be. And this will then help us to scale our positions to achieve a certain risk that we want to have for our trades. And in Forex trading, when we enter a trade, we can choose between different position sizes. There are generally three main position sizes or ways that we talk about positions. And the first and the smallest one is 1 microlot. It means 1 microlot stands for 1,000 currency units. And if you trade 1 microlot, then 1 pip equals $0.1 US. The next higher size is 1 mini lot. A mini lot is 10,000 currency units. Obviously, 10 microlots will also give you 1 mini lots. We will see that in our MetaTrader platform. You can choose a mini lot or 2, 3, 4, 5, 6 mini lots. And once you get to 10, you will get to 1 mini lot. And for 1 mini lot, 1 pip equals $1 US. 10 mini lots or 100 micro lots are then 1 standard lot. And in MetaTrader, this will just be, when you enter position size, it will just be 1.0 as your quantity or your position size. 1 standard lot equals 100,000 currency units. And if the price moves 1 pip on your charts, if you have entered a trade with 1 standard lot, it means that 1 pip equals $10 US. I know that's a little bit maybe confusing, many terms at once, but once we get into the charts, it will become quite clear. I just want to prime you for the different terms. What is leverage? Leverage in trading is important. It is a very often and controversially discussed topic. Basically, it means that you are trading with borrowed money. You can trade larger sizes than what your account offers you at the moment. So, for example, if you want to trade 1 standard lot or 100,000 currency units, you don't actually have to have a trading account where you have 100,000 US or 100,000 euro. If you use leverage, you can have a much smaller account, still have higher position size or trade large position sizes. So for example, if you trade and if you open a trading account, you can choose the leverage with your broker. And for example, let's say we choose a leverage of 100 to 1. Then it means you could enter a position that is worth 100,000 US only by buying 1,000 US. You can see 1,000 times 100 from your leverage will give you the 100,000. Of course, very small price movements then also will lead to very large fluctuations in your account, and small price movements can wipe out accounts quickly if you use a large leverage and in combination with large lot sizes. So there are a few principles for position sizing that I would like to share for you. It's very good as a beginner to stick to them so you don't risk losing your account all at once or encounter big losses early on. Generally, traders should not risk more than 1% per trade. What is 1% and how do you get that? This is what we will do in the second half of the video, where we will actually size a trade together. So this way you can have a string of losses and you still be able to trade. Even if you lose 5 or 6 trades in a row, you will lose 5 or 6, 7% of your trading account. It's not that much in a percentage base. You can still recover quite quickly if you have a few good trades. And you want to be in that position where even though you lose money, losing money is not pleasant, or losing a trade in general is not pleasant. But if you stick to smaller position size, the 1% rule is good for beginners. You will still be able to recover, because protecting emotional capital is very important. Emotional capital means that you still enjoy trading, you don't fear it, you don't have encountered large losses where you dread trading, where you are fearful maybe. And you need to really protect your position or your emotional capital, and that is done by managing small positions and getting into trades with smaller positions. So let's go through an example here. Let's say you have a trading account of 5,000 US dollar. 1%, as I said, of the 5 is the 1% rule, and 1% of 5,000 US dollar is here 50 US dollar. So on every trade, you would risk 50 US dollar, and when your price hits your stop loss order, you will then lose $50. Of course, stops are not guaranteed, and you should read the small print in your broker's risk disclaimer, especially when a price moves significantly during volatile phases. Stops will not always get executed at certain levels. That's very important. But at the same time, you should never ever trade without a stop loss in the first place. Also, if you don't have a stop loss, you don't really have a way of sizing your positions. So the first step is that you define how much is 1% of your account. In this case, it's 50 US dollar. And now in the second step is that we measure our stop loss distance on our charts. When we enter a trade, we find how or where we want to put our stop loss, and then we can measure the distance between our entry and the stop loss. And once we have that, whether it is 5 pips, 10 pips, or 50 pips, then we can calculate the right amount of lots bought. Don't worry, we don't have to do that manually. There is a position size calculator, which I will put a link to in the description below. And also we will take a look at now. Once we dig into the charts, we will make an actual step-by-step example together, and I will show you how to size your trade correctly. And welcome back to the second part. Now we will go through a trade or example together where I show you exactly how to size a trade the right way. So here we are in our trading platform, and I've pulled up the Euro US dollar. You can see this is a broker where you have 5 decimals. And I said in the PowerPoint that in trading or in Forex trading in general, we use pips. But when you have a 5-digit broker, you will get pipettes instead of pips, which means that 10 pipettes are 1 pip. And I will show you exactly how this works. So you can click your mouse wheel. If you don't have a mouse wheel, you can just go here for this crosshair, and then you will see you have, as I said, a crosshair. You can now just click on any one part of your trading platform, hold the mouse button. You can see now there is a number which is changing when I move it up or down, and those are the pipettes. You can see now it is at 130, 20 to 102, and those are the pipettes. So we have to divide it by 10 to get the pips. So in this case we have 20.2 pips. This is just more accurate way of showing the pips actually, because when the broker charges the commission or adds the commission to the trade, usually the commission is somewhere between 1.6, or at least you have a decimal as a commission figure. So if you see that you have pipettes, then the commission and everything else will be a little bit more accurate. That's the only reason. And you can see you can use the crosshair here now to move to measure the price move. So for example, from the top here to the bottom, these are 1,910 pipettes, which is 190 pips. From the bottom to the top, we have roughly 160 pips. And you can see this is basically all there is to measuring pips. When it comes to position size calculation, we should open our terminal, which is here. I think you cannot see it. Let me move it down a little bit. So it's here. It will open up this little window. It's also the Control T, the shortcut. It will open up here. You can see you have other tabs here. And I just opened a new demo account to show you. I set it to 5,000 US dollar. And now we want to enter a trade where we have a risk of 1%. As I said in the PowerPoint, 1% of 5,000 is 50 US dollar. So we want to risk 50 US dollar. Let's say we want to enter a trade for at this current level for whatever reason, and our stop loss is a buy trade. That is, we want to open, and this is just an example. There are no rules. This is just for an example of how to size a trade. So let's say our entry will go here. The stop loss will go at this point. Let me actually use a horizontal line. So the stop loss just goes here, and now we have to measure the distance between the current price and where the stop loss will go. So for that, we just use our tool, our mouse crosshair tool. We will go to the current price, then just drag it down, and you can see we have, let's call it 18.1 it was. So let's call it 18 pips. So now we go to our position sizing calculator. This is the one from Baby Pips. I will put a link to the description below the video. So now we just have to fill it out. You can see here we have everything. Account currency is US dollar. We have a $5,000 account. We want to risk 1%, and the stop loss was 18 pips. The currency pair is the euro US dollar. We calculated, and you can see we have to risk, or the risk will be 50 US dollar. You will risk 27,700 units. This equals 0.2778 standard lots, or 2.7 mini lots. The way MetaTrader works is that you will always buy standard lots, so we have to enter 0.28 since we cannot go that deep. So let's just go here on trading. We go to new order, and now you can see we have everything here. We can order 0.28, and then this we will just enter a buy trade, as I said, buy the market. So it means that the trade will be executed immediately. We have market execution here. We could also enter a pending order, but we want to enter a market execution. We buy now, and you can see the trade was executed successfully. You can see now we have here all the things that belong to it. We have a commission which is already charged here automatically, the entry price, and now we want to put our stop loss to 18 pips. As I show you, you can just move your you click on here this green line, and then you just drag it down to get the stop loss. We want to set it now to 18 pips. Let me just zoom out. We have to accept the one-click trading conditions again, read them before. And now let's zoom in so we can actually see what is happening here on the left hand side. So we drag this down, and you can see once we get to minus 180 pips, 85, 80, you can see that when we hover over now, let me delete the line, and when we hover over the stop loss, you can see our profit is now minus 50.4. so you can see this is very, very accurate. We have now risk 50 US dollar. If the market will go down to hit our stop loss, we will be out with 50.4 US dollar in a loss. Of course, sometimes the stops won't get executed in times of high volatility, and this is something you have to consider as well. That's the risk of trading. And now you have correctly sized a trade. You can see the price goes up and down. You can see we are now in a profit. The stop loss is here. And now let's just set a target. For example, we again click on the entry order, and when we move the mouse up, you can see now here we have TP, and this is the potential profit. And you can see here when we move up and down, the value will change, and so we can set our take profit order as well for a potential profit of 214 US dollar. And when the trade reaches this area, it will get executed, and the trade will automatically be closed and credited to our account. And that's all there is to position sizing. So you have it won't take that long when you do it on your own. You just have to determine where's your current entry price, how far is the stop loss, using here our crosshair tool. Once you have the pips, you just go to the Baby Pips calculator, put in the numbers, you will get the standard lot size, and then you can just size your position. That's it. I hope you enjoyed that, and I will see you in the next video.